Hello viewers, welcome to my channel. I am Hasham. Last video I have explained you about the meaning of the term partnership, features of partnership, and what are the provisions of the Partnership Act that will apply when the partnership deed is silent, and what are the different methods of maintaining the capital accounts, fixed capital, fluctuating capital, how to make the profit and loss appropriation account, and interest on drawings. These are the topics already I have covered in the last video. In this video, I am going to explain you about the accounting treatment when a new partner is admitted. So if you have not watched the last video, I suggest you go to the playlist of my channel. Select the subject Advanced Accounting New. Watch the video of Partnership Accounts 1. Be perfect about the concept, then you can understand the problems. All the problems are based on this theory. And apart from that, in examination, the theory will also be asked. You cannot depend only on problems. The examiner expects that the student must know the basic concepts. Now, in this video, I am going to start the topic admission of a partner. So, whenever a new partner is admitted, normally, when the partners wants to expand the business, they want further capital. They want some expert person. In that case, the old partners will invite a person to come and join the partnership so that it will be beneficial to the new partner and also the partnership firm will grow. So by introducing new partners, the partnership business will expand. New capital will come in and new expert, new skills, new technology, all efforts the new partner can bring in. That's why it's very common that in partnership, a new partner may be admitted. So what are the accounting treatment? What are the adjustments to be made whenever a new partner is admitted? That's what I'm going to explain you. So watch the video till the end. Don't skip in between. So following matters should be considered on admission of a partner. First of all, treatment of goodwill. Normally in coming every problem, we come across this point, goodwill. So what is goodwill? How to treat the goodwill when a new partner is introduced? That I am going to explain. First point. Second, revaluation of assets and liabilities. It's a common thing that whenever a new partner comes in the business, the old partners will decide that the assets and liabilities should be revalued. Because if any gain arises on that revaluation, that gain should belong to the old partners. The new partner should not share the benefit from revaluation of assets and liabilities. That's why we have to revalue all the assets and liabilities. Third one, adjustment regarding accumulated profits. Sometimes the old partners have made some reserves, accumulated profits in the balance sheet. So before the new partner comes in, the old partners will share all the accumulated profits or accumulated losses. Then fourth one is change in profit sharing ratio. Whenever there is admission of a new partner, the profit sharing ratio will get changed. Earlier only two partners were sharing the profits. Now third partner has come in. In that case, the sharing ratio will change. So this also requires some treatment. Last one, adjustment of capital in proportion to new profit sharing ratio. Sometimes the old partners will say that our profit sharing ratio has changed. So our capital should also change according to new profit sharing ratio. But this point will not arise in every problem. One or two problems will come across where adjustment of capital according to new profit sharing ratio. But the first four you will find in most of the problems. So first of all, I am going to explain you about the treatment of goodwill. Goodwill means reputation of the business, the good name of the business. When a business is an old established business, so automatically it will have more customers, it will have some reputation. Automatically when the business is old one, a reputed one, then definitely the profit will be more for this business. The goodwill is a thing which distinguishes between an old business and a new business. Old business will have the goodwill, reputation, but a new business, first time it is going to start, it will not have the goodwill. Over a period of time, the goodwill will be generated. So suppose A and B are running the business since last 20 years. They are having much goodwill, reputation in the market. So now after 20 years, they have introduced one new partner, C. Then what will happen? C will also get the share from the super profit, because this company is an old business. They are running since last 20 years. They are having goodwill. So that reputation benefit the new partner will also get. So the old partner will ask the new partner, you are going to share the benefit of our reputation. So you have to pay some extra money apart from capital. So the new partner should bring some extra premium, some extra amount, and this extra amount will be shared by the old partners because they are losing the share. Earlier only two partners are there, half of 50-50 they were sharing. Now a new partner has been brought up, so their share has decreased. The old partner's share of profit has decreased. That's why the old partners will ask the new partner to bring some extra money. That extra money is called goodwill. So when a new partner is admitted in an old established business, it is usual for the old partners to ask for the new partner some compensation in return for the share of profit that they will have to forego due to his admission. So the wording says, whenever a new partner comes in, the old partners will ask the new partner that we are going to, forego some share of profit in your favor. We are losing some share of profit. So for that purpose, you have to pay some extra amount. You have to compensate us. That compensation is called goodwill. The compensation which the new partner has to pay to the old partners is called goodwill. Goodwill is nothing but the amount or compensation which the new partner brings in, and that will be given to the old partners. That compensation is called goodwill. Goodwill which the incoming partner brings will be in addition to his capital. Capital is different, but the goodwill is the extra amount he has to bring. And this extra amount he is bringing in only for the old partners. Now, treatment of goodwill. When a new partner comes in, he brought some goodwill. How to treat it? So here in India, we have accounting standards given by the ICAI, Institute of Chartered Accountants of India. So according to AS 26 states that goodwill can be recorded in the books only when some consideration in money or money's worth has been paid for it. So in India, AS 26 says goodwill should be recorded in the books whenever the business has paid some amount in money or money's worth terms to purchase the goodwill. When a business purchases the goodwill, then only goodwill should be accounted, recorded. Otherwise, when no money is paid, goodwill should not be raised. Two types of goodwill is there: inherent goodwill and purchased goodwill. So AS 26 says only purchased goodwill should be recorded. Inherent goodwill, which is generated in the business, should not be recorded. Now, therefore, only purchased goodwill should be recorded. If the business has paid some amount to another person to purchase the goodwill, then it will be recorded. In case of admission, retirement or death, goodwill cannot be raised in the books of the firm as no consideration in money or money's worth is paid. So in a partnership firm, when a new partner is admitted, when old partner retires or death of a partner or change in the profit sharing ratio, in those circumstances, goodwill should not be raised according to the provisions of AS 26 because there is no money or money's worth paid for goodwill. It is just creating goodwill, inherent goodwill. Hence, as per AS 26, it is not permitted to raise goodwill at the time of admission. The amount of goodwill should be adjusted in partner's capital account. Then how to be recorded? When it is not to be recorded, goodwill should not be recorded. Now how it should be adjusted? So the alternative is adjust the goodwill in capital accounts. Without raising goodwill, without writing the word goodwill, adjust the amount in the capital accounts. Now, accounting treatment. This is the general brief discussion about the treatment, how to treat the goodwill. Now, how to make the adjustment in the accounts when goodwill has been brought. Now, the goodwill on admission of a particular partner may be dealt in any of the methods. Now, here I have specified 3 methods how the goodwill will be dealt when a new partner brings goodwill. First, when cash payment is made by the incoming partner to the old partners privately without bringing goodwill in the books of account. Sometimes the new partner brings cash for goodwill and paid this cash to the old partners privately. It will not be recorded in the books. No entry will be passed because the new partner brings cash for goodwill and pay this goodwill privately, not in the books of accounts. So no entry is required. This is the first situation. Second situation, when new partner brings his share of goodwill in cash. Now he is bringing in cash. He is not paying privately. The new partner is not paying the goodwill in cash privately, but it is being recorded. So how to record it? So here, according to the provisions of AS 26, the following treatment should be given. So what is the treatment? First of all, when the new partner brings cash, bank account should be debited. Bank account debit, new partner's capital account should be created. New partner's capital account should be created, being the cash brought by the new partner as goodwill. First entry. Now, new partner's capital account debit, old partner's capital account credit. Now, whatever goodwill has been brought by the new partner, the bank was debited and new partner was credited. Now, second entry will be new partner's account should be debited and the old partner's capital account should be credited. That means the goodwill will be shared by old partners in sacrificing ratio or old ratio. What is sacrificing ratio? I'll explain by the end of this video. So this is the new one. Alternatively, only one entry will pass. What is the common thing in the first 2 entries? First entry, bank account debit, new partner's capital account credit. Second entry, new partner's capital account debit. That means first entry, we are crediting new partner's capital. Second entry, we are debiting new partner's capital. So new partner's capital is getting closed. Same amount we are having. So why to credit and debit again? Instead of that, only one entry can be passed. Bank account debit, old partner's capital account credit. Being the cash brought in by the new partner as goodwill, and this goodwill is shared by old partners in sacrificing ratio or old ratio. Right? This is the treatment. Now, third one. Instead of adjusting the value of goodwill of the firm through partner's capital account, another method is widely followed. However, it is not strictly according to the provisions of AS 26. Actually, AS 26 has specified this method of recording the goodwill. When goodwill is brought in cash and it is recorded, then it should be recorded in this method. But another method which is widely used, that I am going to explain, but this method is not suggested by AS 26. But it is being followed by many business houses. What's that? Bank account debit, goodwill account credit. This is the old method. It is not accepted by AS 26, but still it is prevailing. So, bank account debit, goodwill account credit. This is the entry when cash is brought by the new partner for goodwill. Then second one, goodwill account debit, old partner's capital account credit. The first time we are crediting goodwill, second entry we are debiting goodwill, right? And the old partner's capital account is credited. Being the goodwill shared by old partners in sacrificing ratio or old ratio. This is the method which is normally followed. Now note, when the new partner brings goodwill in cash, but it is withdrawn fully or partly by old partners. In the coming problems, we'll come across a situation where the old partners have not kept the amount of goodwill in the firm. They want to withdraw. Whatever goodwill amount they are getting, they are withdrawing the money from the firm. In that case, old partner's capital account debit, bank account credit, because money is going out. So bank account should be credited. This is the entry when the goodwill is withdrawn by the old partners, either wholly or partly. Then sometimes, last case, fourth case, sometimes goodwill may be evaluated in case admission of a partner when incoming partner is unable to bring in cash any goodwill. A situation will arise where the goodwill will be raised. The goodwill will be evaluated. That means the new partner is not in a position to bring the goodwill in cash. When the new partner is unable to bring goodwill in cash, goodwill will be adjusted in the capital accounts. Goodwill will be adjusted in the capital accounts. In such a situation, goodwill is not raised in the books since it is an inherent goodwill. It is preferable that such value of goodwill should be adjusted through partner's capital account. The entry will be new partner's capital account debit, old partner's capital account credit. When the new partner is not bringing the goodwill in cash, we should not raise the goodwill. If we raise the goodwill, it amounts to inherent goodwill. Inherent goodwill should not be raised. In that case, what is the alternative? New partner's capital account debit, old partner's capital accounts credit. Whatever is the share of goodwill of new partner, that share of goodwill of the new partner will be debited to new partner's capital and credited to old partner's capital in the sacrificing ratio or old ratio. Right? Now, note, if goodwill account appears in the books of the firm at the time of admission of a partner, it should be written off. Sometimes, very rarely, at the time of admission of a new partner, goodwill is being there in the balance sheet. Already existing goodwill is there in the balance sheet before the admission of a new partner. So that existing goodwill should be written off by the old partners. Goodwill account will show debit balance. If you want to remove it, you have to credit. The goodwill account will be created and old partners will be debited. This is the entry. Right? Now, sacrificing ratio. The last topic in this video is regarding sacrificing ratio. The sacrificing ratio is required to be calculated whenever a new partner is admitted. Why sacrificing ratio? Because the old partners will sacrifice some share of profit in favor of the new partner. Earlier, only two partners are sharing the profits. When a new partner has come in, now all the three will share. Then what will happen? The old partners have to sacrifice a share of profit in favor of new partner. Then we need to calculate sacrificing ratio. Because goodwill will be shared in sacrificing ratio. In examination, very frequently they will ask a theory question regarding explain sacrificing ratio. So whatever points I am explaining now, remember those points, note it down. Definitely you can be able to attempt the theory question on sacrificing ratio. Sacrificing ratio is the ratio which is applied whenever a new partner is admitted. The old partner will sacrifice some share of profit in favor of the new partner. Now, sacrificing ratio need not be calculated in every case. If the share of the new partner is given, for example, the new partner's share is 1/5 in the firm, then it is assumed that old partner sacrifice in the old ratio. Remember, sacrificing ratio every time no need to calculate. Suppose if in the problem the share of new partner is given. Example, the old partners are A and B. Their profit sharing ratio is 2:3. And a new partner C is admitted with a share of 1/5 in the whole business, in the whole firm. The new partner's share of profit is 1/5 in the whole firm. Then in that case, no need to calculate sacrificing ratio. Even if you calculate sacrificing ratio, you will get the same old ratio. What was the old ratio? 2:3. If you calculate sacrificing ratio, again you will get 2:3 only. So why to calculate? So whenever the new partner's share is given, no need to calculate sacrificing ratio, old ratio, sacrificing ratio, one and the same. Goodwill will be shared in the old ratio since old ratio and sacrificing ratio will be same. Now, however, if the old ratio and new ratio both are given, then we need to calculate sacrificing ratio. For example, if old ratio is between A and B is 2:3 and the new ratio between A, B and C is 3:4:5, then we need to calculate sacrificing ratio. So when there is a need to calculate sacrificing ratio, when old ratio and new ratio both are given. Example I have given here. Two partners A and B, the old ratio is 2:3. A new partner C is brought in, and that means C has been admitted. In that case, three partners A, B, C. And the new ratio between A, B, C is 3:4:5. In that case, we are given the old ratio and we are given the new ratio. In that case, we calculate sacrificing ratio. How to calculate sacrificing ratio? Old ratio minus new ratio. Calculate the old ratio minus new ratio, you will get the sacrificing ratio. That's it. So in this video, I have explained you about the meaning of the term goodwill, the treatment of goodwill, how the goodwill will be adjusted, and the sacrificing ratio. Inshallah, in the coming video, I'll explain you more about this admission. That means revaluation of assets and liability, adjustment of accumulated profit, profit sharing ratio, and adjustment of capital according to new profit sharing. All these things I'm going to explain in the next video. Remember, this theory is very, very important. If you watch with full concentration, definitely you can easily write in examination the theory aspect of this partnership accounts 1.